Chapter 13 is a toolbox of the important numbers every investor should notice. Peter Lynch walks you through the measurements that separate sensible buys from traps, and he shows how to use simple arithmetic and common sense judgment to turn those numbers into practical decisions. Percent of sales. If you become excited about a single product, ask what percent of the company's sales that product represents. A hit product can rocket a small company upward, but it may barely move the needle at a giant corporation. Legs helped Hanes dramatically because it was a big part of a small company, whereas Pampers mattered far less to the enormous Procter & Gamble. Price-earnings ratio and growth. The price-earnings ratio, the number you get when you divide the stock price by last year's earnings per share, should be considered relative to the company's earnings growth rate. A helpful rule of thumb Lynch uses is that a fair price-earnings ratio roughly equals the anticipated growth rate in percent. So if a company is a 12% grower, a price-earnings ratio near 12 is reasonable. If the price-earnings ratio is only half the growth rate, that can be a bargain. If it is twice the growth rate, that is often a warning sign. He also offers a quick enhancement that adds dividend yield into the equation. Add the long-term growth rate and the dividend yield. Then divide by the price-earnings ratio. A resulting number of 2 or higher is very attractive. Cash position. Cash matters. Lynch shows how to read the balance sheet, to find cash in marketable securities, subtract long-term debt, and divide by shares outstanding to see how much net cash exists per share. He uses the example of a car company that had a large net cash cushion per share. When you subtract that cash from the market price, the operating business can look remarkably cheap. Cash can also reveal hidden value in subsidiaries or finance arms that deserve their own valuation. Always check whether the cash per share or the value of related businesses materially reduces what you are really paying for the core business. Debt and debt structure. Not all debt is the same. Lynch distinguishes bank debt and commercial paper, which can be called in at short notice, from funded or long-term debt that matures many years in the future. A company weighed down with short-term bank debt is fragile in a downturn. One with mostly funded debt has time to recover. He gives concrete contrasts. 2 electronics firms with similar problems but very different debt loads. One survived and rebounded while the other went under, all because of debt structure. For turnarounds, debt is often the make-or-break item. Dividends are a comfort and a discipline. Companies that pay reliable dividends, and especially those that have increased them for decades, tend to hold up better in market panics and give investors a tangible floor under the price. But dividends also mean management has fewer cash piles to waste. Younger, fast-growing companies often do not pay dividends because they reinvest cash to expand. That can produce far higher returns for patient investors, but it is a different risk profile. Lynch likes a mix. Some dividend-paying stalwarts for defense, and some fast growers for upside. Book value and hidden assets. Book value is easy to find, which makes it tempting, but book value on the balance sheet often misstates reality. Assets can be vastly overstated. Think plant machinery that fetches only a sliver at fire sale auctions. Or vastly understated. Think land, mineral rights, cable franchises, or radio and television stations bought decades ago and carried at historical cost. Lynch emphasizes digging into what the book numbers actually represent. Hidden assets, tax loss carryforwards, and valuable subsidiaries can create special asset plays, but you must understand the quality and liquidity of the assets. Cash flow and free cash flow. Cash flow is the money the business actually generates. Free cash flow is what is left after you pay normal capital expenditures. Companies that produce large free cash flow, for example, certain pipelines and utilities, can return huge amounts to shareholders even if accounting earnings look modest. Lynch calls out the importance of distinguishing raw cash flow from free cash flow, because the latter is the real cash that can be used for buybacks, dividends, or paying down debt. Inventories. Watch inventory trends. If inventories grow faster than sales, that can signal trouble. Unsold goods pile up, markdowns follow, and profits suffer. For retailers and manufacturers, inventory mismatches are often the first warning sign. Pension plans. A company's pension obligations are real liabilities. Annual reports now lay out pension assets and vested benefit liabilities. A large deficit is a major negative, especially for a turnaround candidate. Always check whether pension assets cover promised benefits. Growth rate and the arithmetic of compounding. Lynch returns to the single most powerful idea. Earnings growth compounding over years produces the biggest gains. A company that grows earnings at 20% a year will, after a decade, be far more valuable than a 10% grower starting from the same base. He uses cigarette companies as an example of how price increases and margin control can grow earnings even in a low or negative growth product category. The arithmetic of compounding is why finding sustainable faster growers is the key to 10 baggers and big winners. Profit margins and the bottom line. Finally, pre-tax profit margin, what the company earns on each dollar of sales before tax, is a quick indicator of competitive strength. Comparing margins within an industry shows who the low-cost operator is. High margins provide a buffer in hard times. Low margins can mean spectacular upside on a recovery, but also higher risk of failure during downturns. The chapter's theme is plain. Learn to read the important numbers, know what they mean in context, and combine them with simple judgment. Percent of sales tells you whether a hit product matters. Price-earnings ratios must be judged against growth. Cash and debt reveal safety or danger. Dividends and cash flow reveal management priorities. Book value can be either a siren or a friend depending on asset quality. And compounding growth is the real engine of large returns. Use these figures to build a quick 2-minute story for each company and you will be far better prepared to pick winners and avoid traps.